what do you think this product should look like in the future? Where do you see payday loans as acceptable tools for families and individuals that need capital? And if not payday loans or these type of non-traditional loans, what would you tell someone in that situation would be an acceptable place to find that capital or credit?
Well, as I mentioned, I don't think I can, from my experience with working with my clients, I can't say that there's that I absolutely cannot say that there's no place for a small dollar loan, because it's clear that that people run into problems. I don't think they're being used well. I don't think that for whatever reason, like you said, the majority of my clients cannot go to their family either. My one particular client had a unique situation where she actually had somebody. But you're right, most of the people, it's not just them. It's their mother, it's their sister, it's their brother, it's their cousin, it's their neighbors. It's everyone who's dealing with kind of these similar issues because they all come from the same community. And what it would look like would be something that would be reasonable, that might be able to be paid back. That the purpose of especially the larger ones, is being used for an emergency. So similar to someone who has their student loan funds being held up, or someone who has a bonus that's coming in the next month, but they have an expense now, or, that's exactly the point of these loans and the purpose that I think where they're useful. It's hard for the people that just have the income problem.
And before we open it, have you had an opportunity to look at the pilot program type products that we see at Opportune or in Skit?
Not in depth. Yeah. I've heard from them, and in preparing for this, I've read about them.
Well, we would definitely love to continue dialogue with you in the future, and maybe you could take a look at those products, and we would be happy to visit you in Orange County and maybe talk to Mr. Allen, our vice chairs from the Huntington Beach area.
I know.
Maybe in the future we could do something where we would meet some of these individuals. I am very concerned, as Ms. Brown, that we have not had an opportunity to meet a number of individuals yet that have actually used these products. One of the reasons I sent out the survey across my district and got, I think, a very robust response over a weekend. We sent it out on a Friday, got several hundred responses by Monday, is because I am very interested in hearing from actual consumers of these products. So with that, we're going to open up for questions on the panel.
I wanted to ask the question of anybody here. Have you ever sat in a payday loan or installment loan business and watched the people who came in? Has anybody here done that?
I think James might have some experience, then maybe Paul. Well, we will ask everyone, please try to keep your answers. We are running short. We have to be out here by 5. If we could please try to keep the answers to about 30 seconds, because we do have one last panel after this. They'll be very brief.
When I founded Opportune, I sat in the booth in a East San Jose store for 6 months, took applications. It was all in Spanish, a lot of Mexican music blaring, families. And one thing we focused on was simplicity. How do we make this really easy to understand? And that whole idea of we lend you $1,000, pay back $1,200 was a key part of that. And so people would think, okay, my cost is $200 because that's the difference. And we made it very simple to them, very clear and transparent that all these payments reduce principal, and the final payment, the loan is repaid. So have been there in front of families and trying to help them, succeed.
The reason I ask that is because I look at our panel, I look at everybody in the room, and I don't see any of the people that are using your product. I don't see any of the people in here I don't think there's anybody in here that's used one of those products. And I really believe that we need to get into the weeds and find out what people need. People have needs, just like she's saying they're filing bankrupt, but people still have the need for the money. And our society right now has just created a real issue because it's not there. They're not making the money on their salaries. I mean, most places are just not paying the kind of money that they need to exist. Everything has gone up. So we've got to figure out how we can really solve the problem so that people who have a need can come and have that need met. But people who may not, may need to learn how to spend their money wisely. Maybe an education piece should be a part of this, that if they know how to spend their money, then they won't have to go there. But if they need it, it's there for them to have.
Excuse me.
Assembly member, I just wanted to let you know, I know under the pilot program and some of the ideas that have been floated today, financial education is part of the process. So I think that will help in solving some of the issues. I think I just wanted to throw some perspective into who doing the payday loans, some numbers, because I know we've been asked to provide some numbers. And I think it's interesting to note that I know one of the other assembly members was asking about default rates and loss rates. I don't think we ever heard it on payday. So payday lending, according to the annual reports from the Department of Business Oversight, the loss rates are less than 3%. That's 12 million transactions a year, so about 1 million transactions a month. And the federal government tracks complaints on these. So if we want to ask the consumers, how do you feel about the transaction you just did? Mm-hmm. You would think that if there's a lot of abuse going on the regulated side of the market, that would show up in the number of complaints. And in 2014, from California, the federal regulator, CFPB, tracks it. It was 510 complaints. 510, and we do 1 million transactions a month. So I think that may give you some insight into the customers that choose to use the small dollar payday loan product are generally happy. And 5 loans and less account for over 1 million customers a year. I know the 10 loan per customer number was thrown out, but we don't bother to look at 5 transactions or less. That's almost 1 million customers. So the vast majority are satisfied. But I think we've already pointed out, everybody here's already pointed out, over 500 and under 2,500 there's a lot of room that's needed for a new product innovation. Thank you.
Just quickly, I mean, I think that Dan's point about defaults is really important, but there are 2 ways to measure defaults when it comes to payday loans. First of all, let's remember that a payday lender has a post-dated check that they can deposit. So they have a very advantaged way of collecting on that loan that is not necessarily about consistent with other unsecured credit where the borrower has to choose to pay that. They can deposit that check. They expect the borrowers generally to come back to their store to make a payment. While it's true that on a 3 or 4% default rate per transaction, research that has been done based on state data, not California because we can't access that sort of data, that we've done, that other independent researchers have done, have shown that if you look on a per borrower basis over a 2-year period, default rates per borrower are 40 to 50%. 40 to 50% of payday borrowers will at some point default over the course of a 2-year period.
And what's the loss severity with that?
I'm sorry?
And what's the loss severity?
Well,
default just means paying late. How much credit is actually?
No, that's actually that ultimately they are ultimately defaulting on their loan, on that loan. But again, it's a question of how you measure.
I think that's statistically wrong. Yeah. You're talking about 2 different things. Loss is different from default. Default is not meeting the terms of the loan.
A borrower ultimately a single borrower tracked over a 2-year period, 40 to 50% of those borrowers will at some point default.
I think we will let you guys settle this offline. Mr. Linder, I think you made your point. I will follow up with Ms. Brown. Thank you for your question, though. That was very good. I will ask this as the final question on the panel, and I will let everyone answer it with a 10-second yes or no and a quick explanation before we move on to our final panel. Actually, that's not true. I have one question for Mr. Gutierrez after this. When consumers take out a payday loan, an installment loan, or a car title loan, do you think they understand what they're getting into? Is it a lack of understanding or optimism about the future circumstances that will allow them to pay off the loan? Please keep it to it. We'll go around the whole panel, but please keep it very brief if you have a remark.
From my experience with low-income consumers in Orange County, I would say no, they generally do not understand what they're getting into, and it is generally a lack of understanding of the terms because a lot of my clients understand that there is no change. There's no sounds terrible. There's nothing to be hopeful about. They know it's not going to change.
Mr. Furstenberg.
Generally, yes. The disclosures couldn't be larger in the stores, and people understand that they're going to pay $15 per 100 or $17 per 100, depending on the jurisdiction.
Sure. Yeah.
I would agree with that. As we've seen, as the numbers just reported, 97% pay as agreed. And I would agree, we post half-inch size disclosures. I've never seen any other financial institution do that. When you walk in, it's clear on the wall. You know exactly what you're being charged. There's only one fee. It's the price of the loan. If you happen to bounce, there's a $15 fee, and that's it. There's nothing else added on. It's the clearest financial transaction out there.
The answer is no. Based on the experience of fielding phone calls from approximately 100 borrowers of cash call loans, in general, they do not understand the principle of amortization. They cannot translate an interest rate into how long it's going to take them to pay off the loan and what the financial burden is going to be. And there is an extensive amount of behavioral economic literature on the low financial literacy in this country. So the fact that an interest rate is shown does not mean that the consumer has understood it at all.
Paul?
It's not just an interest rate. It is actually the monetary equivalent as well. So they don't get just the interest rate. They're told exactly what they will have to pay and when.
And you provide that in writing as well?
Yes.
I think that the specific disclosures for a specific transaction with respect to a payday loan are clear. What's not clear is what actually the actual experience of borrowers of what the expectation is that on average most will not be able to afford to repay the loan and walk away. They will in fact reborrow after paying off their loan and getting caught in a cycle of debt that will be 6, 10, 12, or 26 loans in a year.
Chairwoman Sherry Trepp has been patiently waiting, and she is speaking today at my invitation. Before we go to her, I think I already know the answer to this question from most of you on the panel, but I will ask Mr. Gutierrez this. Is the underlying economic circumstances that we've talked about at length today that create the debt trap, or are these loan products creating the debt trap? I mean, we obviously have a limited scope of ability to change circumstances for most of the individuals we're talking about. Clearly, my colleagues and I, on a daily basis, are trying to improve the economic realities for millions of Californians. That being said, we've heard a lot of, I think, sobering information today that paints a stark picture for a lot of our neighbors, our classmates, our constituents, that they have to rely on certain economic products to get by. Would you like to add into the design of these products as someone that really created disruptive technology that helped reframe this debate?
Well, thank you. I would first say your own report today, 55% people have a FICO less than 700. There's 20% that don't have credit history. So already with that background, the economic challenges that face those families are real, and those are not changing. And so what they have in front of them is a way for them to get through those tough times in their lives for example, they're not able to rely on a credit card, largely speaking. So those are the reality of the choices they have. I think one thing about the disclosures, we invented, 12 years ago, and are doing it again in InSeeked. We invented the amortization table. We actually give someone with a loan, although it's not required by law, an amortization table that shows all the payments, how all the fees are applied, and how that amortizes down to zero. And that's something that we call that financial literacy and it's done at the point of the sale, because most times you invite people to come to a class, they don't show up until they're actually getting the loan product. Then they're looking at it, they care. So it's taught at a teachable moment. And so I would say, to answer your question, the challenge is that we're stuck coming out of a crisis still. For a lot of people, life hasn't gotten better, and that's driving a lot of the decisions and products that are being offered.
Any thoughts on Mr. Furstenberg's plan?
I'd have to look at I think one idea that's cool is that you have for positive payment behavior, you have a kind of variable rate. That's a cool thing. One thing that a lot of folks are doing, there's some innovators that have been doing online payday loans and then saying, okay, after you take out so many loans and you show good performance, we'll get you to a lower rate installment loan. I think all of those ideas should be part of the good idea solution set that we talk about as things that should be on the table, and love to spend more time on the specific solution.
I appreciate everyone on this panel and all the other members that made up, I think, one of the biggest panels I've ever had in this committee. This is just the beginning of the discussion. We'll continue to work forward and hopefully work with all of you. Chairwoman Treppa, will you please join us? I appreciate your patience. I've invited Chairwoman Treppa here today. She's from the Pomo Upper Lake Tribe. We've often heard tribal lending brought up in the discussion. I thought it was fair to bring and invite Chairwoman Treppa here today to give us a better understanding of what tribal lending means. We've often seen, I think, news stories that don't always represent the true reality of the situation. So with that, Chairwoman Treppa, we'd ask you to be somewhat brief just because we're up against the time is running out for our committee hearing, but we want you to be thorough as well.
Thank you very much. I'll be as brief as possible, and I am extremely patient given we were a landless tribe and had to go through putting land in trust, negotiate 2 compacts. So,
good. I will ask everyone in the back, I would ask you please, the committee hearing is not over. We would just ask all conversations to go outside to show the chairwoman our respect as she speaks.
thank you. Honorable Committee Chairman DeBobney and honorable members of the Assembly Banking and Finance Committee. Thank you for letting me speak today. My name is Sherry Treppa. I am the chairperson of the Habematol Pomo of Upper Lake, a federally recognized Indian tribe. I have represented the tribe's interests as an elected official for the past 11 years and held the position of chairperson for the past 7 years. I am here today to provide you and the Assembly with information on our tribe's lending practices. I prepared a written statement setting out some points we feel would be important for the Assembly to consider. However, as my time is limited to 5 minutes, rather than go through the entire document, I would like to summarize our operations and 2 concerns that exist with AB 268. As a federally recognized Indian tribe, we are responsible for our own regulation. We have a robust regulatory framework. Our lenders are incorporated under tribal law and are licensed and regulated by the Tribal Consumer Financial Services Regulatory Commission, the regulatory arm of the tribe. As a condition of licensure, our lenders must implement internal controls and processes to ensure that business is conducted in a responsible manner and in accordance with all applicable laws. Our tribe owns and operates 4 lending portfolios on our reservation and offer unsecured loans to consumers in amounts ranging from $300 to $1,200. Consumers reach our lending businesses through the Internet. Our loans are not payday loans, as the term is commonly understood. Outside of finance charges, we do not charge customers a fee when they apply. Our loans are set up to be repaid in 20 payments, with payments occurring biweekly or semi-monthly, typically according to when the customer is paid. If a customer makes only the minimum payment, their loan will be repaid in 10 months. Industry opponents claim that consumers who use our products will be locked into a cycle of debt from which they will be unable to break free. This is patently wrong. Our business model depends on helping consumers face difficult financial issues without the serious consequences of defaulting on an obligation, not paying a bill, or incurring an overdraft. This mission is incompatible with the idea of purposely trapping consumers in a cycle of debt. We encourage customers to pay extra or pay their loan off early to reduce finance fees. We help customers improve financial literacy through online courses and materials that are made available on our lender websites. The majority of our customers pay their loans in less than 3 months. Over a 2-year period, only 17% have had more than 2 loans. Some believe that online lenders do not do any underwriting. It is a business imperative that we conduct expeditious and accurate underwriting. Without it, our business could not function. It is a central tenet, if not the central tenet, of lending that one wishes to be repaid the money that one lends. 2 key factors that we consider are ability to repay and willingness to repay. We look at customers' income and existing credit obligations because they help assess ability to repay. We check repayment history because it is the strongest factor in assessing willingness to repay. Less than 3% of the new applications we receive are ultimately approved and funded. Tribal sovereignty is an inherent attribute of Indian tribes that predates the United States Constitution. Generally, states cannot impose their laws on tribes unless Congress, pursuant to its plenary power over Indian affairs, provide explicit authorization to do so. However, as the committee is no doubt aware, tribal governments and state governments do collaborate on a wide range of issues. Accordingly, there are two concerns that I wish to bring to your attention with AB 268. The requirement to display a representative APR for loan products and the disclosure of the underwriting standards that are used. Many factors impact APR, including the date the loan is made, when the first payment is due, the length of repayment, and if promotions were applied. The only accurate way to represent what customers' annualized interest rate would be is to disclose it once all of the variables have been considered. As a matter of practice, we do disclose that annualized rate to the customer before the completion of the contract. However, an annualized interest rate has limited utility when the loan is repaid in less than 1 year. Bank overdraft protection plans help illustrate its limited usefulness. Most banks and credit unions offer overdraft protection where instead of incurring an insufficient fund fee and a bounced check, the bank will cover the overdraft for a fee. This fee can be a per overdraft as well as a per day charge until the overdraft is paid. If you look at this service as a loan, the implied APR can be staggering. A 2007 study found that implicit APR for overdraft plans calculated to be 2,400%. Banks, however, are not required to provide a representative APR before the customer signs up for overdraft protection. With respect to disclosing underwriting, while we are proud of the system that we have developed for trade secret purposes, we would be wary of disclosing anything beyond a simple overview of our process, especially if such disclosures are public record. The reason we would take issue with disclosing specifics is that our process uses proprietary and confidential algorithms. Furthermore, the sheer technical complexity of this process may also make disclosure impractical, unhelpful, and harmful to competition. I hope my testimony has been helpful to you and the rest of the Assembly today. I want also to make clear my sincere appreciation for the Assembly's decision to include representatives of tribal lending in the process of debating this bill, and thoughtful efforts that have been made to engage my tribe in a way that federal regulators have not. I'm happy to answer any questions that you might have. Thank you for letting me
Thank you, Chair. Mr.
speak
Assaji.
today.
Thank you, and thank you for your time. Is your services only available for members of the tribe, and how much interest do you charge?
No, they are online for all customers, not just the tribe.
What is the interest that you charge?
The APR is anywhere, an average APR is 680%.
Thank you.
You're welcome.
Now, what would be the average amount that you would loan?
Roughly $700.
And you said that the average is about 3 months?
90 days, yes.
90 days. So clearly the interest rate is affected by the fact that these are shorter term loans. Where would you say most of your clients come from? In-state, all over the country?
All over the country. California, various states.
Very good. Okay. Any other questions?
Outside of California, do you have a way to check their credit and willingness to pay and all that?
Absolutely. We use, as I had mentioned, a very sophisticated underwriting process, a waterfall process that there are various providers in the space that offer products that enable us to judge the ability to repay and willingness to repay, as I had stated. As I had mentioned, it is a goal to be repaid. Our default rates, I've heard several of them in this area, but a mature portfolios for us is roughly 15%.
Very good. Any other questions? Chairman Trevor, thank you. We would now turn over to public comment. Oh, actually, Mr. Assaji, I think you need to add on, so we'll lift the call if you'd like to add on. Yes, please. Yep.
AB 268, Assajian.
Aye.
Assajian, aye.
Yeah. Do we have anyone who would like to add on in our public comment? Second. If not, I think that'll conclude our committee hearing today. I want to thank all the panelists and to my colleagues, and especially to the Vice Chair. Thank you for being here. I look forward to continuing this discussion as we go forward.